Bolstered by strong construction activity, surety underwriters continue to benefit from consistent premium growth and strong levels of underwriting income. In fact, the 2017 premium levels on track to surpass the $6 billion mark for the first time this decade, according to a recently released market segment report from AM Best. Joining us today to discuss the report and some of its findings are industry analyst David Blades and Robert Valenta, a senior financial analyst. So David, can you provide a backdrop for the current market conditions that surety writers are finding so favorable?
Underwriters of surety coverage have been producing favorable results over the past decade, including 2017, based on the results that we've seen through the third quarter. Premium growth has been achieved over that time, and despite pretty heavy market competition, we've seen underwriting income also consistently produced during that time frame as well. The post-recession economic recovery that has positively impacted the construction industry has been a driver of the premium growth for the surety market, in that the construction industry is the main source of business for surety writers overall. In addition, manageable claim activity during that time has also led to the favorable underwriting results that we've seen, and again, we think that looks forward that can continue on a going forward basis.
So Robert, underwriting income has continually rebounded since 2005. Can you explain why this doesn't come as a surprise to those familiar with the industry?
Sure. So as David mentioned, the U.S. surety market has exhibited favorable underwriting performance over the past decade. In 9 of the past 10 years, annual underwriting income has exceeded $1 billion. We've seen pre-tax ROEs well into the double digits, total ROEs in the low 20% range, and combined ratios in the low to mid 70% range. This has been driven by several factors. First is improvement in the construction economy. This has primarily been driven by privately financed construction projects. Also, sureties exhibit well-established underwriting guidelines, and the pricing environment is adequate. Also, reinsurance has been inexpensive by historical standards. This has enabled cost-effective risk transfer for larger bonds and work programs. And finally, a lot of sureties employ credit risk management practices which can prevent or reduce losses. This can include collateral, which can offset potential losses, as well as funds control, which can prevent funds from being commingled between construction projects.
So what role does competition play in terms of shaping the segment of the insurance industry, and how is it impacting performance?
So the profitability within the sector has added a lot of new entrants to come in. This has really increased the capacity within the sector, as well as heightened the level of competitiveness and created a continuation of soft market conditions. As construction spending continues to increase, it remains to be seen whether the quality of business written by new entrants, as well as the potential for loosening of contract terms and conditions, could cause an uptick in the loss ratio. However, up to this point, that has not materialized. We have seen some M&A activity. In some cases, that has been concentrated with the top surety writers. In 2016, almost 2/3 of surety premium was with the top 10 surety carriers. Generally, premium with the top carrier, profitability within the top carriers is better than the entire industry. This is mainly due to increased scale, as well as niche market expertise and strong relationships with agents and brokers.
And I think it's important that Robert mentioned the potential for M&A activity. I think, with the surety industry, with the results that have been generated over the last 10 years and the potential for that to continue on a going forward basis, I think some of the larger companies that might be looking to diversify might look to some of the smaller or regional surety carriers and see them as good targets to add an aspect to round out their overall business, especially with the profitability that a lot of these companies have been generating.
So David, how might those smaller niche players be impacted by a potential infrastructure boom?
I think that's definitely something that's important looking forward. I think one of the things that we spotlighted in the report was the performance measures of the surety carriers for which surety business represents more than 50% of their overall net premium base. Now, while the largest insurers on a direct basis of surety business have been the larger multinational or national carriers, it's these smaller surety specialists that will be most acutely impacted if there is, indeed, a nationwide infrastructure rebuild. And I think that's what's important for those companies, because again, surety business is what drives the success or failure of those companies. So great opportunities coming into the marketplace would have a much bigger chance to give them an opportunity to drive premium growth up, and if they do a good job underwriting, drive profitability, in addition to giving them a chance to enhance their overall business profile. A lot of these companies, again, are smaller and regional companies, so depending on where the infrastructure projects take place, it may have a benefit to them from an overall perspective. If it's in their areas that these projects are undergoing, it'll give them new business opportunities.
So we've talked about how increased spending might bring new opportunities. Might it also bring challenges for surety writers?
I think just like with most things in life, great opportunities also often come with great challenges. Definitely, if there is a full nationwide infrastructure rebuild, surety underwriters should see more business flowing, and you should see more bid bonds, payment bonds, performance bonds, and the like. However, it's also likely that increased competition will be ratcheted up, and that will take a market competition that's already at a high level and exacerbate it further. The question is, will new market entrants or companies looking to write more surety business provide that coverage with less stringent contract terms and conditions than the companies that have been writing that business in the marketplace right now? If that's the case, it could weaken the overall underwriting strength of that business. So that's something we'll look to see going forward. In addition, underwriters of some of these new projects definitely have to make sure that they understand the full scope of those projects, especially larger projects that involve general contractors and many different subcontractors. Those kind of projects will present much greater exposures, new exposures, and new potential losses. So that's something that the underwriters will have to look at. In addition to any problems that may arise from the continuity of financing for these projects. Again, if these projects that are undertaken are too large, sometimes they are prone to default, and that's something that underwriters will have to include and be circumspect about when they're considering their new business opportunities.
Okay, David and Robert, thank you so much for speaking with us today.
Thank you.
Thank you.
To see a full copy of the report, visit ambest.com. For AM Best TV, I'm Meg Green.